What's going on, guys, and welcome to my channel. Today we will study and learn about candlestick patterns, what candlesticks are, and how they can help you to understand charts. Candlestick charts are used by traders to determine possible price movement based on past patterns. Candlesticks are useful when trading as they show 4 price points, open, close, high, and low, throughout the period of time the trader specifies. Candlesticks, enabling the traders to interpret or understand price information and movement quickly just from a few bars. Each candlestick has 3 basic features: the body, which represents the open to close; the wick or shadow, which indicates the intraday high and low; the color, which reveals the direction of market movement, which a green or white body indicates a price increase, while a red or black body shows a price decrease over the time. An individual candlesticks form patterns that traders can use to recognize a major support or resistance levels. Candlestick patterns indicate an opportunity within a market. Some provide insight into the balance between buying and selling pressures, while others identify continuation of patterns or market and decision before you start trading. It's important to familiarize yourself with the basics of candlestick patterns and how they can inform your decisions. Just form 6 bullish candlestick patterns. A bullish pattern may form after a market downtrend and signal a reversal of price movement. Candlesticks are indicators for traders to consider opening a long position to profit from. Upward trajectory hammer. Hammer candlestick pattern is formed of a short body with a long lower wick and is found at the bottom of a downward trend. A hammer shows that although there were selling pressures during the day, ultimately a strong buying pressure drove the price back up. The color of the body can vary, but green hammers indicate a stronger bull market than red hammers. Inverse hammer is similarly to bullish pattern, but the inverted hammer being that the upper wick is long while the lower wick is short, which indicates a buying pressure followed by a selling pressure that was not strong enough to drive the market price down. The inverse hammer suggests that buyers will soon have control of the market. Bullish engulfing. The bullish engulfing pattern is formed of 2 candlesticks. First candle has a short red body that is completely engulfed by a larger green candle, though the second candle opens lower than the first. The bullish market pushes the price up, ending in an obvious win for buyers. Piercing line. The piercing line is a pattern made up of a long red candle followed by a long green candle. There is usually a significant gap down between the first candlestick's closing price and the next open green candlesticks, which it indicates a strong buying pressure as the price is pushed up to or above the mid-price of the previous day. Morningstar candlestick. Morningstar candlestick pattern is considered a sign of hope and an end of downtrend market. It is a 3-stick pattern with 1 short-bodied candle between a long red and a long green. Usually the middle candle will have no overlap with the longer bodies. Morningstar candlestick. It's a signals that the selling pressure of the first day is subsiding and a bull market is on the horizon. 3 white soldiers. The 3 white soldiers pattern occurs over 3 days. It consists of consecutive 3 long green candles with small wicks, and every next candle close progressively higher than the previous day. 3 white soldiers has a very strong bullish signal that occurs after a downtrend and shows a steady advance of buying pressure. 6 bearish candlestick patterns. 6 bearish candlestick patterns usually form after an uptrend. 6 bearish candlestick patterns is a signal and is a point of resistance. Often the traders close their long positions and open a short position to take advantage of the falling price. Hanging man. The hanging man is the bearish equivalent to hammer candlestick. It has the same shape, but it forms at the end of an uptrend, which it indicates that there was a significant sell-off during the day but that buyers were able to push the price up again, but the large sell-off is often seen as an indication that the bulls are losing control of the market. Shooting star. Shooting star is the same shape as the inverted hammer but is formed in an uptrend. It has a small lower body and a long upper wick. Usually the market will gap slightly higher on opening and rally to an intraday high before closing at a price just above the open, like a star falling to the ground. Bearish engulfing. A bearish engulfing pattern occurs at the end of an uptrend. The first candle has a small green body that is engulfed by a subsequent long red candle. It signifies a peak or slowdown of price movement, and it's a sign of an impending market downturn. The lower the second candle goes, the more significant the trend is likely to be. Evening star. The evening star is a 3-candlestick pattern that is the equivalent of the bullish morning star. It is formed of a short candle sandwiched between a long green candle and a large red candlestick. It indicates the reversal of an uptrend and is particularly strong when the third candlestick erases the gains of the first candle. 3 black crows. The 3 black crows candlestick pattern comprises of 3 consecutive long red candles with short or non-existent wicks. Each session opens at a similar price to the previous day, but selling pressures push the price lower and lower with each close. Traders 3 black crows interpret this as the start of a bearish downtrend, as the sellers have overtaken the buyers during 3 successive trading days. Dark cloud cover. The dark cloud cover candlestick pattern indicates a bearish reversal. Black clouds cover the previous day's optimism. It comprises 2 candlesticks, a red candlestick, which opens above the previous green body and closes below its midpoint. Dark cloud cover indicate that the bears have taken over the session, pushing the price sharply lower if the wicks of the candles are short. This suggests that the downtrend was extremely decisive. For continuation candlestick patterns, if a candlestick pattern doesn't indicate a change in market direction, it is what is known as a continuation pattern. These signals can help traders to identify a period of rest in the market when there is market indecision or neutral price movement. Doji. When a market's open and close almost at the same price, candlestick resembles a cross or plus sign, traders should look out for a short to non-existent body with wicks of varying length. This doji's pattern conveys a struggle between buyers and sellers that results in no net gain for either side alone. A doji is neutral signal, but it can be found in reversal patterns such as the bullish morning star and bearish evening star. Spinning top. The spinning top candlestick pattern has a short body centered between wicks of equal length. The pattern indicates indecision in the market, resulting in no meaningful change in price. The bulls sent the price higher while the bears pushed it low again. Spinning tops are often interpreted as a period of consolidation or rest following a significant uptrend or downtrend on its own. The spinning top is a relatively benign signal, but they can be interpreted as a sign of things to come, as it signifies that the current market pressure is losing control. Falling 3 methods. Falling 3 method formation patterns are used to predict the continuation of a current trend, could be it bearish or bullish. The bearish pattern is called the falling 3 methods. The bearish pattern is formed of a long red body followed by 3 small green bodies and another red body. The green candles are all contained within the range of the bearish bodies, which it shows traders that the bulls do not have enough strength to reverse the trend. Rising 3 methods candlestick pattern. It comprises of 3 short red sandwiched within the range of 2 long. The pattern shows traders that despite some selling pressure, buyers are retaining control of the market. Practice reading candlestick patterns. The best way to learn to read candlestick patterns is to practice entering and exiting trades from the signals they give. If you don't feel ready to trade on live markets, you can develop your skills in a risk-free environment by opening in paper accounts such as Webull platform. When using any candlestick pattern, it is important to remember that although they are great for quickly predicting trends, they should be used alongside with other forms of technical analysis such as our SI indicator to confirm the overall trend. I've come to the end of this presentation. I hope you've enjoyed it, and if you really do, please hit the like button, smash it, and subscribe to my YouTube channel so you always be updated whenever I publish content like this. And finally, any questions or feedback, let me know and I'll do my best to help. I hope you got value out of this presentation. I wish you good luck and good trading, and I'll talk to you soon. Thank you.